The market here in Ocean City has been incredibly volatile over the last few weeks. And one of the big reasons is what has happened with mortgage rates. So what I want to talk about in today's video is primarily about mortgage rates, but I also want to dive deeper on some updated future expectations. There has been some changing of the, I'll say, general mindset among the analyst community, the economist community. And I want to bring you some of that detail because there's a wide range of possible outcomes. And as always, nobody really knows what's coming. But I want to bring you what I know, what I think is going to happen based off of all that data, and then we will eventually see what happens. So the first thing I want to jump into is what happened with mortgage rates. So over the past 3 weeks, they have gone upwards about 0.25%, which was not expected. Now you may be saying, hey, Nick, I thought you said that rates were going to be going down over the course of 2024, and that was the expectation. Now, why that changed was that the market, overall market, and there's a lot that goes behind that I don't want to explain today, but the mentality out there among investors is that, hey, look, if the Fed is going to cut rates the amount of times we think, here's how we view these different investment opportunities, whether it's treasuries, bonds, or something else. That shifted because the Fed, it became clear, was not going to cut rates in their March meeting. And here we are on March 1st, and it's not going to happen, right? It hasn't happened yet. But based off of the inflation reports, the jobs reports that have come out, it's not going to happen. So that was priced in to the investment market throughout the end of 2023 and the beginning of 2024. When it became obvious that wasn't going to happen, investors adjusted. And what that means is now instead of the 4 rate cuts that were expected, now 3 are expected in 2024. And that shifted things. So throughout all of January and the first half of February, what we saw here in Ocean City, boots on the ground, was stronger activity, stronger demand, fewer new listings than expected. That completely shifted over the second half of February, which I'm going to bring you next week in my February monthly market update. So if you want to make sure you see that and you're not already, hit subscribe down below and turn on notifications because that's going to be a big one. There were some things that really changed pretty quickly on a dime that really just go to say and show how fragile and volatile this market is right now. We have a very delicate balance. Now, mortgage rate wise, I started seeing over the past few days, and this was the reason why I held off on this video, started seeing some rumblings with some people out there saying, hey, you know what? I'm actually not even expecting any rate cuts anymore in 2024. I think the Fed's going to hold the line because there's a lot of inflation still to battle. That's a very minority opinion, right? And whether that is for clicks, whether that is because that analysts or that firm's portfolio would benefit actually if those rates do not come down. There's a lot of ifs, ands, and buts. But the key distinction I want to make here is that it's not all positive anymore. There's some flexibility or some breakage in that mentality that 3 cuts, because that's what Jerome Powell alluded to and expected at the beginning of the year, that may change. That may not be the case. So I want to take you through a couple different articles and charts here to help paint the picture. And again, we're going to wrap this up at the end with what does all this mean? How should we respond if we're sitting here looking to buy? How should we respond if we're looking to sell? So the first one I want to take you through is an updated Fannie Mae projection. So this one just came out yesterday, and this is a panelist of 100 experts who really track this stuff closely. And things have shifted, and there are 2 big changes. And there's one key point that determined those 2 changes. Now, when this actual survey took place, I have to imagine it was in the beginning of February, not over the past 2 weeks. It's hard to turn around data hauls and surveys that quickly. So I would not be surprised if this is slightly outdated, even though it just came out yesterday. But 2 things. Number one, home prices have now been increased. Home price expectations, I should say, increased since the last survey. Initially, it was 3.4% by the time we hit 2025. Now it's up to 3.8%. That's not monumental, but it is an upward shift. Now, one of the key expectations down here is that they believe that rates are going to end the year around 6% by the end of 24. And again, that is assuming that the 3 rate cuts happen. That was likely not taking into consideration the fact that rates went up over the past couple of weeks. Now we are sitting here around 7, maybe even the low 7s, depending on, obviously your profile, what type of loan you're looking at. Is it a second home, a primary home, all that stuff? This is broad brush stuff here. Now, some of the insight behind this survey is what I want to spend a couple minutes talking to you about. And forgive me, there's a lot of colors, a lot of lines, and it may look confusing. I'm going to try to simplify it for you. So the short version is they track different paths, right? They have the median, which is, hey, let's take everybody's opinions together. We have the optimists, which is the top 25 most optimistic surveyed participants. And we have the pessimists, the lowest 25, who don't think things are going to get that much better. And you can see here comparing different timeframes. So I really like this chart. Before what they're calling the bubble, right? And that is before the '05 era situation, we had on average per year home sale or home price increases of about 5%, 5.1%. During the bubble itself, that jumped up to 7.7%. It's pretty big. Then the bust on average, again, within the first year, things dropped about 20 to 25%. But beyond that, on average, over that 6-year period, 4.7% negative shift. Now, the big difference here is what we got used to is what we'll call the normal market, which again, reflected basically pre-bubble. We have the bubble and the bust and all these highly volatile timeframes, but when things are normal, you're sitting around 5% per year, right? During the recovery, it was 4.6%. Now we have this COVID reshuffling, I like that terminology, of over 11% per year in home price increase over the last 3 years and 9 months specifically. So what they want to forecast out and try to make sense of is what's going to happen over the next 5 years, right? Anybody can guess next month, guess next year. That's not all too helpful. And again, at the end of the day, nobody has any idea. But people who have tracked this stuff, this is their job, this is their livelihood, have more data points, have more access and more insight than you or I. So I like to leverage them at least as my baseline here. So we have everybody. By the time we get to the end of 5 years, we're looking at, on average per year, 3.9% increase in prices. The optimists are even feel better than that, 6% on average. Pessimists are only 1.6%. Now, this next chart breaks this down, which I really love this. So you can see the 3 tracks. The orange is the pessimists, the blue is the optimists, and the black is the mean, which is everybody. So you can see where things really diverge here over the course of the next 5 years. But let's say best case scenario, right? There are 3 rate cuts, which is the best case scenario at this point, and inventory stays low, which is likely to be the case. 6%, I think, is a reasonable estimate. Now, the pessimists here, and there's not a whole lot that I can find on exactly the specific individual responses to this survey, what the rationale is, why they're pessimistic, but I have to make some assumptions here because I'm feeling this way as well. So based off what I've seen over the past few days with people backing off of the Fed is going to do 3 rate cuts no matter what, that's, gospel, it's going to happen. That may not be the case. And if it doesn't, what happens, right? If there are no rate cuts, 2 things will happen. Number one, we should expect to see mortgage rates continue to increase. Even though the Fed is not increasing their prime rate, the expectations for the cuts were already baked into the mortgage rates that we saw and are still currently seeing. So that's why they came down, right? That's why they came down from the mid to high 7s to then the mid to high 6s. And now they're back up around 7. So if that doesn't happen, they're still saying, hey, look, prices should still inch up, right? 1.3% each over the next 2 years before things start to take off normally again. So they're anticipating this inflation battle is going to take a little bit longer to really tackle. And if you've been not only watching, my videos, but whether it's whatever news source you choose to follow, paying attention to inflation reports, jobs reports, things have been a lot stronger than expected, especially on the jobs front. And inflation came in hotter than expected. And there are so many different ways to track it. There's core, there's super core, which a viewer here and a friend of mine turned me on to just today. And I had to do some digging in before I could record this, because super core inflation basically strips out housing too. And that really looks at, hey, look, what at a services level is the inflation looking like? And that's up at 4.4% in the past month, which is way above, obviously, the 2% Fed target. And one thing that I have learned in all this digging over the past week, that a lot of the analysts that have expected the 3 rate cuts, that are projecting the mortgage rates you're going to see out there everywhere, right? We're going to end around 6, we're going to end under 6. Their assumption, and if you really dig, a lot of their assumptions are admitting and acknowledging that this will not get the Fed to get inflation down to their stated target, and their mission is to keep inflation or get it back down to 2% per year. And it's not going to happen. The 3 rate cuts I've seen people acknowledge that it will only get down close to 3 or 3.5%. So what they're saying is, forget what the Fed has told us their mission is. Forget the fact that we've fought them before, right? And said they're not going to have the gall to keep things high or do whatever it was that was very clear that they should do. And lo and behold, they did it in the face of these expectations. We're saying that they're not going to hold to their word and their mission. And that's a gamble. So if, and this is a huge if, right? And we don't know, this is going to be a month by month thing. But if jobs reports continue to show that the economy is strong, if core inflation and other inflation reports continue to show that things are not trending in the right direction, there's not going to be much of a case for the Fed to cut rates, nor a need for the Fed to cut rates. Now, some of you may be thinking, and I heard a lot about this in my first year, 2020, an election year, all these things were going to happen, right? Because it's an election year. And if a Democrat gets elected, here's what's going to happen. The housing market's going to tank. A lot of my coworkers were telling me that at the time. I asked for proof and there was none. And because it's a bunch of baloney, it has nothing to do with that. But could there be political pressure for the Fed to cut some rates, right? If polls are not going in Joe Biden's direction, I don't know. I'm not worried about that. There's no history and there's no proof that that has ever happened. But I choose to continue to look at the data. And it seems that Jerome Powell, the Fed, that's supposed to be, a independent body, is going to continue doing the same. And if any of these underlying assumptions that have resulted in mortgage rates coming back down, that have resulted in everything that we've seen over the past couple months, if those assumptions turn out not to come to fruition, things are going to change, right? We've seen a lot of that already within the past few months. And again, I expect to see a lot more of that. There's going to be some overreactions, myself included, potentially, to some news that comes out, because each one is just one data point. And the Fed, we should look at things on a much broader scale, which I do here right on my channel with the Ocean City market. Nothing's just a 1 month overreaction for that because we have the data. But I'm going to sit here and keep you updated, right? I cannot tell you what's going to happen. I can only keep you informed. And the key here now, this is the part you may have been waiting for. If you are looking to buy, what does all this mean? In my perspective, interest rates going up, mortgage rates going up is not a good thing, right? It makes things more expensive. You may be thinking, well, if rates have gone up a quarter point, I should wait till they come back down. And there's a possibility that that happens, right? I'm not going to sit here and say it's not going to happen. It could. When? We don't know. And all of that is just this catch-22, this endless hamster wheel that I don't want you to get stuck on. What I want you to keep an eye on is for inventory to come on that fits your needs and actually would work for how you are planning to use the short home you eventually choose to buy here. Because with inventory extremely low and with this spread still, whether rates go up or even come back down to 6, you're still looking at a ton of homeowners here and everywhere who have a 2.5, 3, 3.5, 4, whatever it is, mortgage rate on what they have. And they don't need to get out of that. And if financially it doesn't make sense for them to move on to the next home and sell what they have and lose that rate, they're not going to do it. So if you see a home out there now in the coming weeks that fits the bill, it's the great location, perfect situation, good rental history or no rental history, depending on what you're looking for, I encourage you to take a shot at it at a number that makes sense for you. Because the likelihood, and I've seen this with clients over the past year or two with the low inventory we've had to deal with, if you let one slip because things are not perfectly aligned, right? Mortgage rates, we're not sure what's going to happen, or the price is a hair higher than you want to pay, whatever it is, all valid concerns. You're never going to hear me say otherwise, but you don't want to just assume that we're going to see another one, right, in the next year or so when things are more favorable. There's never a guarantee that that's going to be the case. So if you see something that works, it's well worth exploring. But beyond that, there are still multiple offer situations going on homes that I didn't feel were terribly underpriced. It's not like we had seen in the past where you'd see somebody list 50 to 75K under the last sale, intentionally creating that bidding war situation. These were with homes that I thought were reasonably priced. We're still seeing that. So demand is still there. You don't have time to sit there and stare at it for 3 weeks. You need to be prepared and ready to make the jump. So buyers, keep an eye, and if you see something, reach out ASAP. get in there to look at it. And if it's the right fit, it is worth having the conversation, the serious conversation with yourself, with your agent, me, whoever, to determine if this is worth taking the shot. Now, if you are looking to sell in the near term, what does all this mean for you? As you're going to see in the next video next week, the market update, inventory has gone up, right, over the past few weeks in a pretty remarkable fashion, 10+%. We don't see that. That does not mean you hit the panic button and you sell before anybody else gets out there. Not what I'm saying here at all, because 10% still has not gotten us to 250 active homes on the market, which is still a remarkably low number. But you need to be mindful of what could come. Now, again, my 2 cents, you sell when it's the right time for you to sell. I don't really care what else is happening in the market. Strategically, yes, there are better times if you are trying to time things. May not always work, but you need to be aware of that stuff. We can have that conversation, but I'm not going to sit here and tell you, because of that article I just showed you, because of those charts I just showed you, you should or shouldn't act a certain way, right? This is about you, your goals, your family's financial present and future depend on what you do with this huge asset you have here. It's way too complex and personalized to give you a response and say, here's what you should do, because it depends on the person, depends on the house, depends on the situation. So if you want to talk through that, I'm more than happy to help ask the hard questions, help guide you to whatever answer makes the most sense based on the particulars, based on your factors. Happy to do that. And the contact information for me is right down in the description. As always, call, text, email, whatever works for you. If you want to leave a comment, I can reach out that way as well. But that's it for today. And this one is one I'm going to be tracking closely. There will probably be an update, I'm going to say almost on a monthly basis going forward until we see things even back out. I thought we got there. Turns out not to be the case. So if you like this, do me a favor and hit the thumbs up. I would love to see more people find these videos, because I've heard from people who have chosen to work with me or not, that they've been extremely helpful. So all I want to do is make sure people get the help, get the education to make a confident decision. So thanks as always for hanging out. I'll see you next time.